I actually think this is the first year in 3 or 4 years where people haven't been calling for the 10-year to be 3.5 or approach 4.
Where are we now, 2.8?
2.7, yeah. That's how we've started each of the last 3 or 4 years. I really think this is a good setup. I was on the show at August 28th. I was cautious. I got my head. A lot of people disagreed with that at the time. Earnings, I think I put up a chart from BCA that showed...
Why'd you look at Jim when you said a lot of people disagreed?
Not at all. He wasn't on the show.
I saw that, though, okay?
Yeah, I know. But I think I showed up a chart from BCA that showed earnings expectations were as high as the bubble. Basically, you don't want to own stocks actually when earnings are growing 20%. That's not the time to own it. The time to own stocks is when sentiment is more muted. People are worried, people are scared, people are wringing their hands. I think barring a trade war, which is a huge if, this market works in 2019.
Yeah.
But that's the key. That's the most important.
That's the key to Jim? You think so too?
I think that's
a lot of people think the
is,
Fed. You enter 2019, the Fed's the biggest wild card there is.
Well, the Fed can do a lot of positive things here if they back off their stance. I think the biggest issue here, Scott, is the trade war. But the only thing is, it's not the only issue, right? I mean, you've got a hostile Congress coming in. There's going to be fireworks, Pelosi and Schumer versus Donald Trump. You've got the Mueller investigation that may come to light sometime in February. You got Brexit, and as Amy mentioned, you've got potentially a trade deal coming by the end of February. All of these things could go either way, and the market, you mentioned sentiment earlier, Scott, sentiment teeters one way or the other on the outcome of all of these things. But I do think the trade war is the biggest issue because that has the most direct effect on profits. It has the most direct effect on capital expenditures, aggregate demand, profit margins, et cetera. If you get that solved, I think the other risks become secondary. They become part of the wall of worry that the market can climb.
You guys believe that? I mean, I feel like the Fed is the biggest risk
Do you think I don't think they're going to rise, though. I don't think they're going to raise rates anymore. I think the market is clearly telling them if they don't listen to the markets, that would be a huge negative. But the markets are speaking very clearly right now, and they're saying don't raise.
Yeah, we've had 6 corrections outside of recessions. The average is 19%. That's been our downturn this time. The Fed has paused or cut after 5 out of 6 of them. So I think the Fed, if the market stays where it is or goes down further, I think the Fed's out of the game. But this whole bull market has been a margin-driven bull market. We've had margin expansion from lower taxes. Even before the Tax Cut and Jobs Act, we had effective tax rate coming down. I think last quarter effective tax rate was 14%. That's behind us. From lower interest expense, that's also behind us. And from supply chain management. So if you start going at that globalization supply chain management and reversing that, you're not going to get any further margin expansion, and I think this rally is over.
Look, you guys aren't alone in thinking the Fed's going to back off, right? Goldman, which had 4 hikes for 2019, has come down to 1.
Right.
Well,
now they're looking
in
the first half of next year to 2%, down from 2.4. So they've come in, even though they're not worried about a recession, they just say it's undeniable at this point.
Chicago is looking for cuts in 2020. Right. So, look, those forecasts will always be massaged as you get closer to the event, and they're subject to change. They don't leave them.
Part of my point is how quickly they've changed.
Yeah, they'll change again.
It feels like it's changed really quickly.
I think it's my personal opinion, two personal opinions that I hold. They're weak opinions, but I'm holding them very strongly. The first is, this is not a moment to have a very, very, very strong binary opinion on what next year will bring. Right. There's no reason to, because of the point I made earlier about diversification. By the way, emerging market stocks outperformed U.S. in the fourth quarter. Yep. It's been a while since we've been able to say that. Yeah. Right. So let's put that aside. My other very, very strong opinion right now, is that it's going to be binary, meaning if you have a recession, it's a very different situation for stocks than if you don't have a recession. And I don't think they'll be within 10% of each other. Yep. I think a recession is 25% lower even from here.
I agree.
And a non-recession, I really think we could have a great year in 2019.
Unless you think that the trade war happens or that the Fed does something really off the mark, it's unlikely
trade war is in flagrante. Do we agree?
Well, yes.
It's happening.
But if it keeps happening, you will have the market go down. You will probably cause a recession, and then as you get closer to 2020, the person in the White House is not going to want that.